Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrother, Director of Business Development.
On this show, we talk about real estate investing, business,
and so much more. Back at it again with another podcast. I'm catching Rob off guard, starting this one early, but the show must go on and it must actually start. With that said, I am Craig McGrother, the Director of Business Development with Lone Star Capital, alongside the founder and CEO of the firm, Rob Beardsley. I hope you're doing great in Manhattan today. We got a very fun and important conversation to go over today. This is something that's a little topical. It's evergreen. We're going to be talking to two people here. So you'll know who you are in this conversation in the sense of where you sit in the aisle of things, where this is very specific. We're going to be talking to how this matters and shakes out for investors. If you're an LP, not capital raising, but if you're an LP, a passive investor, looking to place cash into an offering potentially. And we're going to be talking to fund managers and, having a conversation about promote. What is promote? For those who may not be familiar, promote is essentially the upside on a deal where there's a revenue and a profit split. So I'm sure many people, if you're listening to this show, you probably know what this phrase is, a preferred return. So after your preferred return, which is 7, 8, or 9, or whatever the investment vehicle is, that means that up to that point, you take 100% of those dollars. And then after the return, it's a certain return threshold, there is a revenue split after that, the waterfall structure. So you could say a common one would be after an 8% return, could be a 70-30 split, and then perhaps there could be another tier and a hurdle there. But essentially, after that revenue split is the incentive that the manager, that the sponsor would be in receipt of for their hard work, for basically beating, market beta returns. As you notice, 7, 8, and 9%. What does that kind of mirror and correlate to, right? It probably goes off market beta. If you're investing in the S&P 500, the typical return is somewhere in that range. So for a sponsor that you would want to work with, you would want to assume this. You would hope that you get down to this, that they're incentivized and the sponsor makes their money after you've made your money. And then you want them to make an outsized return on the upside of the deal. Not during the management, not upfront, but on the upside of the deal. So that sponsor is incentivized to work their tail off to give you a high return. So this conversation gets a little contentious. A lot of this, if you're working with fund managers, this is kind of the negotiation time period where you're worrying about your projected compensation. First and foremost, we want to work with people who have one person in mind, or two people in mind, I should say, really most importantly. You got to serve the tenants, the people who live at the property in our instance, and you got to serve your investors. And if you do well there and you keep them at mind, then everyone will win and there should be plenty of pie for everyone to split.
Yes. So, like you said, we're couching this conversation for two people, right? First, I guess since we're starting here, we'll start first kind of more so with the fund manager avatar. It's people who have a boutique fundraising business where they partner with sponsors like us, raise capital on a deal-by-deal basis through forming a fund-to-fund, which is an SEC compliant way of partnering on a capital raise. They pull their investors into their fund, which then writes a single check into the actual deal investment vehicle, which is what we sponsor. But although it is technically a GP-LP relationship, it is akin to a partnership because it really truly is a partnership in the way that the fund manager is relying on the sponsor to find the deal, day-to-day operations, execute on the business plan, communicate, distribute, really provide everything to make sure that not just that the investment is a success, but that the investors in the fund manager's underlying fund have a successful experience investing in the deal. Because as we all know, investing in private alternatives is so much more than just dollars and percentages. It's also about the experience. It's about the communication and the sleep well at night and the tax benefits and how things were structured and filed and so on.
Orderly manner that they conduct their business in. And I'm so happy you said the word experience, because that's what life is ultimately, is one large experience. And within that large life experience, you have different experiences if you work with different operators. The beautiful thing about capitalism, obviously, is, you get options. And in this world, in the world that we're in, you've got many options to either raise money and bring capital to a deal if you're a fund manager or an investor. But that's not a one-size-fits-all situation. It is not the same experience through and throughout. As our friend Hunter Thompson always says, and I cite him, he has been in deals where the returns have been great. With a little zoom in there, a deal where the returns are great. You could not be blurrier, and good little audio there. Terrible radio, and
All
even
right,
worse
let me sort
YouTube.
myself out while you handle
Yes,
business.
yes. Well, as I was saying, our dear friend Hunter mentions this, how he's had great deals that had terrible communication, which led to uh, investors not wanting to work with that person again because what? Because bad communication, ultimately a bad experience where individuals didn't know, where they were at, which what, as Rob mentioned, we want to have people sleep well at night. And you sleep well at night by, doing what you say you're going to do, reporting, communicating, being responsive, having your camera work during presentations, all things of that nature, right?
Yeah, so just don't mind my camera here. It's a boomer tech over here.
I didn't know
So,
you had Craig operating the other side of it. That's impressive.
well, it's just ever since I got back from the honeymoon, my camera has now just been acting up. It's
You've
quite odd.
changed. You've changed.
Yeah. So one thing that's interesting that has come to our attention recently is really the I don't want to be I don't want to point any fingers or be disparaging, but the lack of sophistication when it comes to understanding the nature of fund manager compensation. And what I mean by that is fund managers, just as I mentioned, are really truly partners on the deal. And these fund of fund structures are usually set up in a double waterfall manner where there's a waterfall coming from the main deal to the fund of fund. And then there's another waterfall happening at the fund of fund level, at which point the fund manager gets their compensation.
Yeah,
And
and how this works ultimately is essentially, as I said, the waterfall conversation. When you are a fund manager and you raise $2 million for our deal, or a deal, right? You get preferred structure there, so you can compliantly have your investors mirror or match, or if you are generous or less generous, you can kind of customize the return structure that your investors theoretically get. And then you obviously make the difference in between. You can kind of customize it. As I mentioned, it's a little more up for nuance there in that fund structure. And it has that double waterfall structure. So as I mentioned, the waterfall is, what you get above and beyond that preferred return. And then there's a revenue split. And then you have another revenue split within that revenue split as well. So think of Inception almost, but within waterfalls.
the nature of all waterfalls, as Craig mentioned, is that it's performance based. There's no fixed number, there's no guarantee. It's all based on how the deal actually performs. And the whole spirit of a waterfall, like Craig said also, is that there's a minimum threshold of performance that needs to be hit. And then after that hurdle is cleared, then there's an incentive compensation where the manager gets disproportionately compensated. And of course, that only occurs when there's an outperformance. So, similarly, with the double waterfall, the fund manager finds themselves in the same exact boat. They ride and sink with the ship. So, if the deal doesn't perform well, a fund manager could be looking at making zero on a deal, and that's
Yeah,
true
but
even
but
if.
but 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 the projected compensation said I would make something.
Yes,
You see?
you
You
got
see,
me.
this is how it works. So I want to be clear here, and I say that in a joking and in a facetious manner, if you couldn't tell. But when you have a comp structure, it's rarely, if ever, a fixed setup if with returns. There are some maybe broker dealer laws or maybe some sort of structures where that works, but for the purposes of our situation, you're not a realtor where or a commercial broker where you sell the deal and you get X return. Okay. Your compensation and your investors' returns are correlated to the outcome of the deal. It's not a fixed setup. So when we have a deal, when we go through the process, we underwrite this thing very carefully and you get a projected compensation structure, and that's no different for the returns for
Predicated on the deal performing to the projections.
correct. And your projected compensation structure is also a byproduct to how well the investors do, which is why I said, and how well the tenants are. So if you serve the tenants and the investors, you as the fund manager will make a lot more money. Us as a sponsor will make good money, right? But it's not a fixed thing. So myth number one, when we show projected compensation for something, it is exactly what? It's a projection. Projection and pro formas are always wrong. Okay. It's not because we're trying to be inaccurate, but we're working with the best of our knowledge, with the information we have today, putting in numbers, comps, whatever we feel is appropriate and accurate and the latest and greatest information, we are projecting how that is going to work and go. So you are basically, as a fund manager or an investor, are betting on the likelihood and outcome of the sponsor doing, what they say they're going to do. Now, the interesting thing about this business as well is this is not a one size fits all equation for every single sponsor underwriting. Underwriting is, it's like cooking. It's not a perfect science. There's multiple ways to do it. If you give, and you've probably heard me say this before, if you listen to our information, if you listen to me on podcasts before, you hear me say this. If you gave the same operator the same deal, 10 operators, the same deal, you're going to get 10 different outcomes, 10 different ways to underwrite a deal, which can be very confusing to decipher as an investor or as a fund manager. Well, how do I actually know if this person's good? How do I know if these returns are bogus? How do I know if they're just blowing smoke to get me excited to invest in the deal when in all reality they might have bought a lemon or something like that, right? So there's so much that goes into this process. And what ends up happening is you hear everyone say that they underwrite very conservatively. But that is a very, very subjective, not objective, but a very, very subjective way to analyze yourself if you are underwriting conservatively or not so conservatively. Is that right, Rob?
I would say it's just easy to hide behind the generalization, and it's very, very difficult for an investor to call a sponsor out on it, because by just generally speaking, sponsors know more than investors. That's just by definition. Why
They
would
know
an
where the bodies
investor
are.
why would an investor know more than a sponsor? Why would then that investor pay someone else to do something that they know more about, right? Investors at the end of the day pay sponsors to be an expert in something that they're not an expert in, so that they can focus on living their life and focusing on their career and their families, rather than becoming, we drive cars, but we don't build them, right? We're not experts in building cars, but we still use cars, right? And so that analogy carries forth into investing as well. Many investors of ours invest in private real estate. They're not experts in real estate, and that's kind of the whole point. So that goes to say that if an investor will rarely ever be equipped to fully actually debate sponsors saying, oh, well, this is underwritten conservatively, this is a good deal, right? It's very, very difficult for an investor to know. I would say there is an objectivity there, so it does exist. If you show me a deal that I'm familiar with, it's in our backyard, so to speak, I would be able to actually opine and say objectively this is conservatively underwritten, or you know what, I think that this is aggressive on these couple points, or this is how I would do things differently.
And I'm really happy you mentioned that. And because you said backyard, but let's say you're comparing the entire United States of America, right? Well, it's pretty fair to say that if you got a 5 cap rate deal in Manhattan, you've just stumbled upon the best deal anyone's ever had in a core location. That probably wouldn't exist, but let's say you had that. That would be awesome. Now, if you stumble into a 5 cap rate in Lubbock, Texas, that would be probably the worst deal you could find, right? So you see the nuances there and the differences. So that's one thing to point out. And where this conversation is going to move this forward, to go over the kind of the context here, is sponsors right now, and just generally the sentiment, I would argue, and Rob's heard me lament on this fact of late, but the market has a very low point in sentiment. So what a lot of individuals will do, particularly on the sponsor side of things, is they want to get really aggressive to show you incredible, upside and what you're going to make. And, on base case of you raise $2 million, you're going to get X return and whatever. And they get you really sold on the dream. And your the greed mind takes over. So, well, this is great. Surely this is going to happen, right? But there's two ways of doing things. Would you rather have this lofty projection and then be disappointed in 5 years when the deal sells and you don't hit that? Or would you rather look for something that is maybe a little bit more conservative, where you increase the likelihood of your investors doing well, therefore you do well?
So here's the problem, really. It's actually, there's like an inverse relationship where if you gear up a deal and it's underwritten and jiggered in such a way that the projections are here and then the fund manager compensation is projected to be 15% or something that's quite high. And usually the way that that is rigged is through aggressive underwriting, high leverage, and other things that are otherwise unattractive to a fundamental investor and to the actual investor that the fund manager is bringing into the deal. Well, what could happen is 5 years down the road, the deal could quote unquote underperform because the projections were so lofty. And the underperformance could be, let's say, a 12% return, which is still very good and it's still very respectable. And the underlying investors, I mean, if they are, wise and they've been through a few deals, they might recognize, okay, you know what, the projections were high, but the outcome was 12, and that's still pretty good. But the problem, the fund manager is going to be the one left holding the bag because the projections were jiggered up such that they would make that money if the returns were sky high. But because the returns actually ended up being run of the mill, typical, which is, guess what, average, right? Their average is average for a reason, right? Because it's the most common
An
outcome.
average is actually really good in most instances, for the record.
Especially in investing, average is very good.
Yeah.
And so the fund manager is going to be quite disappointed because their compensation was actually predicated on this incredible outperformance. So that's one bad problem associated with these very aggressive projections to get a fund manager lured in. The thing that's even more pernicious, the thing that's worse is, like I mentioned, one of the ways to rig up the projected returns and the projected compensation to the fund manager is to use lots of leverage. And with leverage comes a bigger dispersion of outcomes. And so instead of actually underperforming to a 12, you could actually find yourself underperforming to a 0% return, which just basically means like getting your money back, or even a negative return, which a lot of people are experiencing right now. I don't want to dig up old wounds or, go after people's problems that are occurring right now,
Well, why don't you name drop all the sponsors that are doing terrible real quick?
but there's a lot of bad deals that are going on right now, and a lot of people are experiencing 100% losses because of foreclosure, or just they're selling for very big losses, and things like that. And so in a situation like that, the fund manager in that situation is really screwed because their investors are experiencing a loss and likely just a very bad experience. And we have friends in this business, and we have personal friends who are experiencing this and basically are saying, you know what, just given my experience, I'm swearing off the asset class and I'm never investing in private real estate again. So be it. And that's just kind of the way of the cycle. But when the fund manager invests in a deal that they were lured into because of these high, lofty projections, and it ends up poorly, they lose their investors, and also their projected compensation goes out the window and they end up with nothing. They end up making zero. So that's where, you can say this point until you're blue in the face, but it's so much better to have a low risk, more of a sure thing that's like a decent outcome, right? Like a base hit, a double, a single or a double, versus swinging for the fences and trying to hit a grand slam, because guess what? More times than not, you could end up striking out.
And the reality of this is the following. You only have a business if your investors do well. So many people get in this business of capital raising only thinking about one thing: what's in it for me? And that is the worst way to have a business. That is the worst way to do anything, because at the end of the day, what we are doing is we are serving tenants and investors. What are you doing as the fund manager? You are serving your investors to serve tenants. And that's how the system works. So it's very interesting when people don't look at it from that frame. They only look at the highest projection there, but you're going to quickly lane yourself out of the business. As a fund manager, you only have a couple go abouts this before you basically have the wrap of not being able to raise again. You are not going to be able to raise for money again and for deals again, likely if you choose the wrong winners. You can't be right 50% of the time. Now, if you're playing baseball, you're better than Barry Bonds. Congratulations. But if you're playing investing, you're a heinous investor. So you want to look for certainty. And the other thing is, and this kind of is talking potentially our own book here, but we are buying higher quality deals. Now, if you have a higher quality deal,
Why
what
don't you
does that mean?
explain what that is? Because I think a lot of people might hear, well, it's, oh, well, you're buying a high quality deal. What does that mean, right?
Yeah, sure. And higher quality can range and it can vary. But what I mean by a higher quality deal here is acquiring an asset that is in a very good location in a growth market, which kind of goes one and two, but growth market in a good location in a good vintage meaning year. So this particular asset is newer
Do
than
you mind? Do you mind if
2000.
I interrupt you actually and
Please.
just do a little mini masterclass? So, because I just this thought is just coming into my head. So there's four qualities of a deal that really you can say, okay, because of this, I would say the quality is high and basically risk is therefore lower, right?
Okay.
Higher quality means lower risk. And so the four pieces of quality are location, right? Location is number one, like everybody knows in real estate. And so location, usually when we say that, it's a strong, thriving area where there's stronger chance of collecting the rent that you set, for the rents being what you want them to be and not all of a sudden them falling due to supply risks or due to blight or due to crime and things like that. So location is number one. Better location usually means lower risk in the deal. And next thing would be the vintage, like you said, the year in which the property was built. And so the newer the property, generally speaking, the less likely it is to have deferred maintenance or construction defects and things like that. Now, there's some nuance there, with buying new construction. You need to kind of do some due diligence to know, because it's such new construction, there could be construction
Well,
defects.
in that
But
location, if it's new construction, might not be in the best area because that land wasn't developed yet.
yeah, so I mean, all these things need to be looked at,
Nuance and
comprehensively
factors.
together. But
Yeah.
you've got location, then you've got the vintage. So generally speaking, a better location where the incomes are higher, the schools are better, the crime is lower, things like that. The population is growing, there's proximity to jobs and things like that. So that makes the deal lower risk. Same with vintage. The newer the property, the less likely there is to have major plumbing issues, major electrical issues, foundation issues, and things like that. And also they do kind of correlate as well, because with older assets, you also struggle to attract the best tenants, and that again increases your risk. If you have tenants who all have 150 IQs and $150,000 in the bank, and they have great jobs, you're not going to have to worry about your delinquency. You're not going to have to worry about crime, most likely, and it just overall reduces your risk. The third thing is leverage. Leverage is really important. One of the most important elements. You can take
Your, your,
any
your,
good
your,
deal.
your debt equity structure. Yeah.
Yeah, you can take any good deal and make it bad by just putting too much debt. So higher quality deal means lower leverage.
And if you'd like to learn more about this, please read his book.
So when we say we're doing deals that are higher quality, this is of course subjective, but in our opinion, and it is hitting on these multiple factors. We not every deal, but we are striving to buy the best location that we can, the newest vintage, so the most recent built assets that we can, and we're using lower debt than many of our peers. And some of these things sound perhaps obvious, like, oh, well, isn't it obvious that you're striving to buy in the best location possible?
Well, yeah, you get paid differently, right? You get paid differently for the risk that you take. And risk obviously can hurt you. Your downside is not as protected. But what happens, you think, when, think about this. If you're an investor or fund manager listening to this, if you buy a better quality deal with lower risk, do you think your projected returns should be higher or should be lower? Well, likely they will be lower. But you know what else is lower? Your certain the ability for you to lose your money. And so often people only play offense and throw Hail Marys thinking that, it's a single or a double, like it's certain. It's like, well, you have a very good chance of making potentially good money, but you also have a very higher likelihood of losing it all. And
there's a
when you
reason why, to keep the sports analogies going, there's a reason why a layup is 2 points and a three-pointer, which is very far away from the basket, is 3 points, right?
correct.
The potential compensation is higher for the three-pointer, but the difficulty is much higher as well. And so in investing, it's not necessarily about always shooting for the biggest points, because then you'd just be lobbing up half court shots all day trying to make a three, but that's stupid, right? And at the same time, it could also be arguably stupid to stand right under the hoop and just try to get a two pointer every time. So it's about finding the perfect balance of where you feel like you're being the best compensated for your risk, where you're taking the least amount of risk and in exchange getting the most amount of projected return.
So when you have deals that are lower risk with less leverage, well appointed,
And the
good
fourth one,
vintage, and
I
with the
didn't
right
say it. I didn't say the
okay,
fourth one yet.
okay, go on, go on.
So the fourth one is business plan. And so this is an obvious one, but the business plan obviously has a big influence on the risk of the deal. If you are buying a deal and your plan is to hold it forever and it's to not do any renovations, not to do any retenanting, you're not repositioning the asset, nothing. Well, that's a very low risk business plan. Conversely, if you told me that you're buying unentitled land, you're going to get entitlements, you're going to get permits, and you're going to drop the architect stuff and you're going to go vertical, that's a very risky business plan in comparison to buying an existing cash flowing asset and doing nothing with it. Right. And then there's gradations in between where you're doing some value add, where let's say you're buying a property and you're going to just simply renovate the kitchens by doing new floors, new countertops, new cabinets, and backsplash. Okay, that's not very risky. But what if you said, well, you know what? I'm actually buying this deal and I'm going to add walls, because I think the one bedrooms are very oversized. So I'm actually going to add some walls and I'm going to make them two bedrooms, or I'm going to take these oversized one bedrooms and split them up and create two one bedrooms by throwing up another kitchen. Like, whoa, this is starting to get pretty risky. You don't know if the
You're
market's
trying to
going to.
make a market now. You're
Yeah.
making a market because this is not proven potentially yet.
So the business plan is another major factor. And I think people overlook this risk a lot because they just take it for granted. They're like, oh, okay, so you're going to buy the deal and you're going to renovate and then you're going to raise the rents by $200. Okay, easy, sounds good, no problem. But you know what? That takes time, that takes risk. Even if it is somewhat just like a cut and paste project, there's still a lot of work involved. And there's still risk at the end of the day to labor costs changing, supply costs changing, to the tenant's ability to pay the rent premiums that you're seeking changing, which we
Well,
all
and
saw that
that could,
happen.
which is risk associated because naturally, if you're in a better area with better incomes, better appointed, you probably have tenants who can withstand a potential recession or a potential economic slowdown or have more savings or families that could bail them out.
Right. So class A, obviously apartments that cater to renters by discretion or discretionary renters who have more disposable income, definitely less risky than catering to those who are more income insecure. So anyway, those are the four elements of quality slash risk. And like Craig pointed out very importantly, all those things, the more you dial up the quality, the more you're lowering the risk on the deal. But consequently, due to the relationship between projected return and risk, the more you dial up the quality and therefore turn down the risk, the more you're actually turning down the projected return that you're going to see on the spreadsheet. Because we all know that the long-term projected returns, let's all just agree, roughly speaking, that the long-term projected returns on multifamily investing is around 15%. But the way you get to 15% can be wildly different, because you could be a madman and invest in a bunch of crazy, risky, high leverage turnaround deals, opportunistic value add, where each deal you do has a projected return of 30, but one of your every two deals goes to zero or breaks even, right? And gets a 0% return. Or, you could just try to hit base hits and be very stable, thoughtful, and just kind of get there slowly but surely.
So the point gets to that if you are doing a deal that is better quality in nature, has lower leverage, all the things I just mentioned, your return structure will also be what? Your returns are not going to be higher. Your returns are going to be a little
Your
bit
projected
lower.
returns, that
Your
is.
projected returns, a very good
The
caveat,
actual outcome.
could be a lot higher, but you don't know because no one knows the 5-year plan. And if you do, call me. I'd love to invest with you. But the return structure should likely go down. Okay, that's just how it works, which also means that what? If you're a fund manager, the likelihood of you making some outsized return in capital will probably go down, but there's a greater certainty that you'll be able to collect some upside, some promote, some of that revenue split on the back end, and your investors will be able to have that. But you don't get better quality, better located deals with less leverage and get higher returns projected or higher promotes projected. It doesn't work that way. It's a trade-off. But we're seeing so many people right now who were probably thinking that they were going to make 20%, 15% projected comp on their deals or whatever that are now making a grand total of nothing because the deal, if you're lucky, got the original capital back, or maybe it got wiped out. Well, you're not making promote when that happens. So realize that the projected conversation is just projections. And who do you want to be? Do you want to have greater certainty of making something, or do you want to potentially roll the dice and lose it all or be disappointed when that doesn't happen? Maybe it works out, maybe it doesn't. But we want to be in the camp where over the course of time, there is a greater certainty that you will make a consistent amount of money that is predictable and reliable if you do, in fact, work with us. So we're trying to increase certainty, and we do that with all the things that you mentioned. And we want to be conservative in nature because we don't want to overpromise and underdeliver. What's going to happen is a lot of people right now are going out to raise money, and they're going to give you these lofty projections that are probably, frankly, bogus. And then you're going to be really excited about it. And you're going to say, oh, I'm going to invest this deal because the projections look better and it's higher. But they're, of course, just projections. And in 5 years from now, you're going to be probably disappointed with that outcome and be wishing that you were in a safer deal with a greater likelihood of actually, hitting the projections because our inputs are not as egregious and as lofty as others that we're competing with in the marketplace per se.
It takes, to build experience and to build a track record in the investment business like ours takes a long time. It takes forever. It takes decades really to build up that sophistication, that experience. You're that wise old guy who's been there, been through it, knows it. And it takes forever to really learn what is so simple. And which is the fact that people are all fixated on return on investment when they should be focusing on return of their original investment.
So can you pull up the covert underwriting to show an example here? And you might ask, oh, well, that all sounds nice. Show me an example. Well, good thing we've got an underwriting guru here to show you. And his technology is going to work perfectly like it has been this whole podcast. He's going to show us a real-time example of exactly what we mean. So if we changed one of our assumptions, just one, why don't we change, Rob, just for this conversation's sake, why don't we change the exit cap rate on this said deal, which is not a solicitation, but why don't we show the exit cap rate on this deal from a 5.25 to a 5% just to show what the outcome and difference looks like. Okay.
Sure, that sounds good. And of course, this is just for discussion purposes. This is not a solicitation to invest in this deal or any of our deals. So just as a disclaimer, but here, just as a long story short, cut to the chase, we have a 10.3% projected fund compensation structure. And like Craig said, if we were to lower the exit cap rate by 25 basis points, which, exit cap rates,
well, let's also, by the way, let's not only show the projected compensation from manager. Why don't we also go to the summary section, though, please, and show the investor returns and how that all flows? You could just, no?
Well, that's the fund of fund doc. So, I need to show this.
Yeah. Cool.
So what would you like to see here?
Well, let's just show from a retail, just typical LP. Why don't we go there? You see, it's just shy of a 15 IRR, roughly an 18 AAR, an 18 AAR. Why don't we go though, Rob? Now, if we could just change that one little itty bitty output, and this is kind of how you
want to see what the investor returns are.
Yes, please, thank you.
Okay.
So that little nuance change there brought the IRR up almost a whole 100 basis points, one whole point. Okay. But now let's go crazy and let's go back to the fund to fund section. If you want to pull up that underwriting, please, and change that one input where your projected compensation on a base case, situation where we feel comfortable goes from just shy of 11 to over.
Whereas 10.3 to now 12.2.
So you see how juiced up changing these things are. So what happens are people get you excited about your projected comp, but guys, the deal didn't change. Nothing changed here. All we did was show you a slightly different input there, and the output totally changes. Okay. So this is how people get you excited and how they overpromise and underdeliver and give themselves a future and tomorrow problem. They're trying to stay alive right now and raise during a difficult time, a lot of people. So they're going to do whatever they have to do to financially engineer something that you knew, or they're going to take advantage of your greed. And they know that you're going to be very excited about that. Never mind the potential downside.
The difficult thing for people to learn and accept is that
They're greedy.
yeah, and that
They're soulless.
there isn't as much magic out there. People get sold on the idea that, hey, I got this deal. The broker called me in the middle of the night. He said it was a secret. Don't tell anyone. And if you bid this
And
number,
you're the first guy they're
and
calling.
if you're the first guy. You're the only people we're showing the deal to. And if you're able to, buy the deal today, we'll give you at this price. And everyone, when you're newer into this business and you're kind of just like an investor, not really fully into the business, you believe these stories more and you believe that there's actually a greater variation in deals. But the reality is the deals that we're buying aren't really any different than the deals that somebody else is buying. We're all seeing the same deals. We're all part of the same market. We're all a part of the same networks, the brokerage communities, and so on and so forth. And so when someone is, if we're all looking at the same deals, we physically can't be really projecting or delivering really much differently on the returns. And so if someone is someone is not necessarily being greedy or generous if they're projecting and offering you better terms or a better projected compensation. It's just a manipulation, and manipulation sounds negative.
No, but it is. You're manipulating and changing the numbers, as we just showed you one little input there.
Yeah.
We could get greedy and go out with said deal with very lofty structuring, but then we would probably lose sleep overnight because we know we're doing something that would probably relatively be unethical. So not only would it be unethical, but we don't want you to come to us in 5 years saying, well, you promised me this and it ended up being that. Well, we don't promise, we project, but you projected this and it's that. And I'm mad now. And we'd rather you be like, hey, well, you know what? It's so funny. You projected that deal as a 14, ended up being an 18. Yeah, we'd rather be that guy. Not you projected a 20 and it's a 12, which would still be a good return. I would take a 12 any day of the week, but that's besides the point.
Yep. So I think unfortunately, when it comes to this topic, you can never talk enough about it because it's very difficult for us humans to learn this. And that's why we're all usually condemned to actually underperform the indexes, right? You look at the stock market's incredible performance over the last 100 years. Well, how many humans have actually been able to enjoy that performance? Almost none, because everyone's buying in at the top when everyone's excited and they're selling out when everyone's depressed and the market's low. And the same is true in the private markets in our business of multifamily as well.
Jeremy Irons in the movie Margin Call is the coolest guy ever as a character, just being that guy. But he has a very good quote, and I'm paraphrasing here, but it's like, we're all humans. We can't help ourselves. This is why cycles happen. And it's true, because if everyone who bought their deals in 21 and 22 sized it up with 10-year fixed rate debt or 7-year fixed rate debt and not over levered, the cycle would not be a problem right now. But why did that not happen? Because those deals would probably projected somewhere between a 9 to a 12% return, and you wouldn't invest in them.
At best.
And you wouldn't invest in them. And you wouldn't invest in them. And you wouldn't invest in them. So that said, the nuanced conversation here is very important. And the other thing you want to be asking yourself here, and I'm really now speaking more towards the fund managers, the thing you want to be asking yourself here is, why do I get some XYZ split? Why would some group give me a 100-0 split, meaning they're not making any dollars on the back end? Or why is their base case a 95-5 or a 90-10? Why are they so generous to me? Ask yourselves, if you're an investor or a fund manager, how does the sponsor get paid? Are they fee clippers? Meaning they basically make money no matter what the outcome of the deal is, where they're going to make an outsized amount of money on property management, asset management, acquisition fees, disposition fees, refinance fees, XYZ miscellaneous bogus hidden fee that you don't know about that probably is not really relevant. Are they making money there, or is their compensation directly tethered to the upside and the performance of the deal, which by serving the tenants and serving the investors, you get a great return? How do they make their money? At Lone Star Capital, we keep the lights on by doing acquisitions, but we make the money, and Rob buys the fancy things and takes his lovely wife out to dinners based on the promote that we ideally make, which helps you and everyone involved here. So that is kind of the moral of the story there, is be weary. And if something feels too good to be true, really dig deep and ask why you're getting that. Okay. Because chances are you're probably a good guy, but you're not that special. Okay. So, and I mean that with all due respect. Okay. I mean that with all due respect. I know this might get contentious. You might be cursing the air right now, and this might hurt your paradigm, but this is the pill that you have to swallow right now, particularly in this marketplace, is how are you getting manipulated on the numbers to see something that is not true? If you're an investor seeing a 5-year hold and a 20 IRR, not AAR, but an IRR, which would be roughly about a 26 AAR and a 5-year hold, that doesn't make sense. There's no free lunch out here. These deals that most people are buying, particularly if they're north of 120 units, are very well covered. Okay, you're talking about middle market institutional deals that BlackRock, the XYZ people, the Apollos, they're buying these things.
The
Okay.
Lone Star Capitals.
Yeah, exactly. Same sentence, same breath, as everyone knows, obviously. But people are buying these things. They're bidding on things. These are competitive processes. Okay. Unless you're working with an operator who knows where many bodies are hid, you're not getting some screaming deal or some off market or whatever it may be. Okay. So those situations are very nuanced. We may have one. I don't know. Maybe we do. Maybe we don't. But maybe we're just different in that regard in one special way, which if you reach out to me, you might learn more. But with that said, I hope this is very educational, informational. If you think that someone needs to hear these words, like as the phrase goes, I don't know who needs to hear this, but send this to that person. Reach out to them and help this concept really, really sink in and help people learn. And if you don't invest with us, at least mark these words as something that you learned something today, because this is pretty universally true within this whole ecosystem of private equity investing. I would say we're only really experts in one thing, which is multifamily. Can't speak to you about other stuff per se, but I think this is a very, very important conversation that should be frankly evergreen. And if you want to learn more about our offerings, if you want to learn more about our summit coming up, which is nearly sold out, reach out to me. You know the email, but once more, it's Craig, CRAIG at LSCRE.com. Rob, any final words before we let you go?
Good to go.
Good. All right. Well, thank you so much for your time today, people. And by the way, if you have any questions or if you have any comments, if you have anything that you want us to answer, anything in depth, help us help you. Give us the gift of content to give to other people. Reach out to me. You know the email. Anything you have there specifically like us to cover, holler at us. Take care, everyone.